Good afternoon or evening, whichever time zone you may be in. We will be getting started in a moment.
Can you hear me, Amy?
I can.
Very good.
Okay.
You just let me know when you want me to pipe in.
Okay. So this evening's program is being offered both in English and in Spanish. And no matter which language you want to listen in on, you're going to need to go to the toolbar for your Zoom and find, there's a little, looks like a little globe on the right, and click on that and pick your language, either English or Spanish, in order to hear the presentation. And we'll give you a little bit more explanation on that, but go ahead and pick your language. And we're going to get started. I'm Amy Bach. I'm so glad that you were able to make the time to be with us today for this United Policyholders Roadmap to Recovery program. Of course, I'm sorry that you are in a place where you need this kind of information and what you've been through, but I'm so pleased and proud that our nonprofit organization is able to bring you this guidance free of charge. Thanks to our staff, our volunteers, and our funders, and the 3 decades of experience that our team has had in helping people navigate the road to recovery after a wildfire. Before I get into the details of what we're going to cover tonight, here is the information for Spanish-speaking folks. That's that globe icon there. That's the one you need to pick, English or Spanish. So you got to pick one. And there you go. All right. A little bit about United Policyholders. We are a reputable and very well-established 501c3. That's a not-for-profit organization, a charity, like the Red Cross or the Sierra Club. We have what's called the Platinum Guide Star rating because we run a good above board ship. Very much a traditional insurance consumer advocacy organization, not selling anything, not trying to get you to hire us, but here to give you information and guidance. And that's what we've been doing for 30 years. And so we have a lot of information and experience under our belts that we can share with you. We are a trusted information resource and a respected voice for you as an insurance consumer throughout the United States. We're funded by donations and grants and an outstanding volunteer corps, one of whom is with us as one of our instructors tonight. Team Up, as we like to call ourselves, consists of professional staff, myself, Sandy Watts, an insurance specialist who's with us tonight, our government and nonprofit partners, and then our volunteers. And our volunteers include what we call survivor to survivor, previous catastrophic loss survivors, or people often don't like the word victim, we use survivors, who are paying forward lessons they learned and want to share and make your road a little easier. And then we also have volunteers who, like one of our speakers tonight, who are professionals that you could hire if you needed to and so chose, that are consumer oriented. You're not going to find people on our volunteer corps that work for insurance companies because they work for insurance companies, and we are your advocate. Not that it needs to be a war, but it is a financial dynamic. We're on your side. So also we have lawyers, we have public adjusters, tax and financial planning experts, construction and real estate professionals, all on our team. We run 3 programs. Tonight's program is brought to you through our Roadmap to Recovery program. And that's very much focused on the nuts and bolts of getting on track, staying on track with an insurance claim after a disaster. And the other two programs are very important as well, because through our preparedness program, we try to help people have enough insurance so that they don't find themselves in that 2/3 underinsured statistic. And then through our advocacy and action program, we are always working. Through our advocacy and action program, we are always working to solve problems that you may be encountering on your path. In Colorado, we've helped change laws to help you in California and in Oregon, and pretty much in every state. We've had a hand over the years in trying to strengthen your rights to get treated fairly and get through the process as painlessly as possible. We are the publishers of this book. I'm one of the authors of that book. You may have seen that along the way. So some fine print, we are just here to give you general guidance. I know a lot of you have questions, individual questions, but our goal here is to basically teach a class about a topic that affects a lot of people. And so if you have a specific legal question or you feel like you need professional claim help, we recommend you consult an experienced professional, either an attorney or a public adjuster, CPA. And we do not endorse or warrant any of the speakers at our workshops or the professionals you'll find in our Find Help directory. But we do our best to identify professionals that are, like I said earlier, consumer oriented and will be helpful to you. We're not creating a professional client relationship with anyone here tonight. We are here as educators. So that's me, Amy Bach. I'm also joined tonight by Chris Rockers with the claims group, Sandy Watts, as I mentioned earlier, an insurance specialist with United Policyholders. I'll tell you a little bit more about the three of us quickly. So I've been a professional insurance consumer advocate since 1984. I co-founded this organization. I have written a number of books and lots of articles. And I am a voice, one of the voices for consumers of insurance in many different places where decisions are made that affect you. So in courts, in legislatures, and in government. A lot of my work for the last 30 years has been focused on helping you, the person who's bought insurance, get a fair shake. Chris has over 2 decades of expertise in advocating exclusively for insured commercial and residential property owners after a loss. Chris, I've been talking now for a few minutes. If you want to just tell us about the other 2 bullet points here.
Yeah, I'd be happy to, Amy. So I have served on the Rocky Mountain Association of Public Adjusters. It's a regional association, so public adjusters need to do the right thing as well. They're licensed by the various states and the departments of insurance. So we're obligated to do the right thing, but we stand in the shoes of the insureds. I have also authored a number of different articles in the Real Estate Journal on property insurance topics.
Thank you. And, the reason that we invited Chris is, he knows a lot about the subject of depreciation that we'll be talking about tonight. And also he has been a volunteer with us for a number of years. And so we know that he adds value in an educational setting like this. Another one of our instructors tonight, very special, valuable for insurance consumers, Sandy Watts. Sandy, you want to just give us a little recap of your background?
Hi, everyone. Nice to see you all tonight. Just a quick, I come from the insurance industry. I worked for State Farm. I see we've already got a couple of State Farm questions. I was a adjuster and team manager for State Farm for 25 years. Different company sort of back then, but I also have a background in fire and water and mold restoration. And we'll do our best to get you the information that you need tonight to help you along with your claims.
Great. So just a few reminders. This workshop is aimed at people who lost their homes or whose homes were damaged in 2020, so a year ago. So by now, I'm hoping that most of you have been on at least one or two of the webinars, if not all of the ones that we've been offering. So you kind of have a feel for what we recommend generally, but these are just a few reminders about keeping your claim on track, keeping up your journal so that there's a clear paper trail of who said what to who and who did what when. And then we recommend a couple practical things. We're here tonight talking about depreciation and the valuation of your damaged or destroyed property. And using one credit card when you're replacing items can really help you with getting a fair settlement and having that paper trail be clean. A lot of times people get confused as to what checks have come in and in what category. And so these are just reminders to help you stay organized and on track. A lot of people find it very helpful to have a bank account, one bank account where you deposit all your insurance checks separate from other accounts that you may have. If you haven't been doing that, it's not the end of the world. It's just something that is some people find helpful. And then of course, because it's important to have receipts when you buy things that replace items that were lost, that you save and scan and keep them in one place for reimbursement. And we're very aware that for most people who have a wildfire loss, it's very hard to stay organized because you're dealing with regular life as you had it before, plus a whole lot of other things. So understanding that you may not be as organized as you'd like to be, these are just suggestions. And then staying in regular contact with your insurance company, of course, is very important. And confirming that you're cooperating with them on a regular basis is a good practice. And also having a clear line of communication about how much your insurer has paid you and in which categories, so that you can anticipate what more you are owed or is available to you. So those are just some basics. This is a really useful and free organizing tool that a wildfire survivor donated to our organization, a spreadsheet. And I've given you the link there that you can open it up from our website free, and you can use that to keep track of your insurance claim. So just a reminder that first checks are a starting point. And you very likely by now, hopefully, you've gotten quite a few checks for both your dwelling and your contents losses. And we encourage you to think of those often as starting points, not necessarily the last word. And just that reminder that you're entitled to the cost of repairing and rebuilding your home as it was before the fire, up to your policy limits, including whatever extended coverages you may have. And very often there's math involved and mistakes can be made, and that's why we're here tonight. The topic we are talking about is one of the more confusing ones for most people because it involves math, and sometimes it's a little bit counterintuitive. A lot of people feel like, well, I had a bedroom set and now I don't. So why is it complicated? Why is there math? This is what it's going to cost me to get that, replace that bedroom set. But insurance companies have designed the process to be orderly for them. And so depreciation is just a fact of life in the insurance claim process. Sandy, you want to just explain this chart?
Yeah, especially after disasters, there are the insurance companies, and it depends on your state, but in general, they're trying to get money to people for certain things, ALE advances, obviously, for living expenses and so forth. But a lot of companies will come and pay you in advance on your contents claim, or pay you in advance on your structural loss, to sort of buy time while they're waiting to determine the actual cash value. So we'll get into what actual cash value and replacement cost, what those terms really mean. But advances are different than actual cash value payments. And some states have, like California, for instance, has a mandatory advance for certain items.
And of course, if you live in Colorado, there is the insurers are supposed to give you an advance of 30% on your contents. Chris, have you been encountering a good number of people who have not gotten paid that 30%?
I believe most carriers have been good if it's a total loss primary residence. There have been some carriers that assert that if it's a secondary home, they're not obligated to issue the 30% that is noted by the statute. And the statute does say primary residence, but the intent in my mind is to assist those that have lost everything, whether it's a primary or a secondary home. But for the most part, the carriers are pretty good about issuing that 30% advance if it's a total loss, and if it was the primary residence.
Okay, so just the lingo, we're going to be repeating these and explaining them a couple times, but just to make sure everybody is familiar with what we're really talking about here. There are two components of depreciation. One is replacement cost, the replacement cost value of an item, an object. The other is the actual cash value. And then we know that in insurance world, people tend to throw around acronyms, and we're going to try not to do that. But generally, people talk about replacement cost as RC, and they talk about actual cash value as ACV. And then the concept that we're here to talk about, depreciation, is which sometimes gets referred to as a holdback, is basically a valuation that the insurance company holds back. And sometimes they hold it forever, in which case it's non-recoverable. You don't get that depreciation back. And sometimes it's recoverable. You do get the depreciation back. So it can be temporary, that when they depreciate the value of your loss, or it can be permanent, depending on the language of the policy and the rules in your state. So replacement cost basically is what it would cost you today to actually go out and buy a replacement item. So replacing old for new. Most homeowners policies today, but not all, provide replacement cost coverage. In the past, it was much more common to see only actual cash value policies, and you still have in your, even if you have a replacement cost policy, there still are parts of it that provide actual cash value coverage, sometimes permanently and sometimes temporarily. Actual cash value, ACV, is the pre-loss value of an item. We often talk about it as the Craigslist price, or the eBay price, or thrift store price. It is the price that a willing buyer would have paid you immediately before the loss. And then the cost to replace the item, less depreciation, which is supposed to be based on primarily the condition of the item and also on its age. Those are the two ways that you can calculate actual cash value. Some policies, as I said, limit payouts just to ACV, particularly manufactured mobile home policies. Depreciation, again, it's the loss in value of the item due to age and condition. Policy language varies, but generally, insurers will apply depreciation to what they pay you on both contents, dwelling, and other structures. So again, just those terms that you're going to hear, and some of them kind of mean the same thing: holdback, withheld, recoverable depreciation, non-recoverable. It all relates to how your property gets valued and what your insurance company is going to pay you, either in the short term or in the long term. And why does it matter? So coming up with cash to buy replacement items can be hard, especially if your insurer has heavily depreciated your property. And typically your insurer is going to depreciate the value of your damaged or lost property to account for its used condition and age. But for all items that are covered for replacement cost value, unless the insurer relaxes or waives the depreciation requirement, you often have to actually replace them and submit proof in order to get the difference between the depreciated value and the replacement value. So, so I'm going to ask both of you. I think, you know, we see adjusters all over the map on depreciation, correct? Do you sometimes see a situation where, I'll start with you, Sandy, where an adjuster will just cut a person a check without applying depreciation? Do you see that sometimes?
Sometimes you see that more in structural losses than you do in contents losses. The typical time when that happens is if they hit their policy limits.
Right, or if they're very underinsured.
Very
You see that
underinsured, yeah.
sometimes. Chris, you see situations where an adjuster does not apply depreciation to some of these items?
Well, yeah, there are certain things that they should not apply depreciation to, but my experiences is oftentimes the carriers may apply what could be considered excessive depreciation. And what I believe is important is when the homeowners prepare their inventory, they don't simply just submit the inventory to the insurance company. It's their claim, so they should actually have a role in determining, even though it's a labor intensive effort, what their replacement costs are and what their ACV is. Therefore, they're telling the carrier what their claim is, as opposed to letting the carrier suggest what their claim may be or their payout should be. But the contents portion of the claim is one of the more difficult and onerous ones, because you truly are trying to capture everything that you lost. And you know, part of this exercise here is explaining that there is no set rule on how to apply depreciation, what is reasonable and defendable. And oftentimes, if homeowners don't provide their own replacement cost pricing and take into consideration what an ACV payment is, they're allowing the carrier to do that. And oftentimes by doing that, the carrier may withhold more funds than may be supported.
Yep. Yep.
But I see depreciation applied all the time.
So, and you know, one of the reasons we wanted to do this class tonight is depreciation involves math. So right there, it causes problems. You know, mo problems, but also it's confusing for most people. And I think, you know, what you heard what Chris said, I would say, like, Chris, okay, you can hire a guy like Chris to take on your claim and handle all the paperwork for you. Chris, would you say on a typical loss, you spend most of your time on the contents or the dwelling, or can you characterize it?
Yeah, I guess it varies by the individual claim and the homeowner as to the volume of possessions they had. And even though some may seek the assistance of a public adjuster, on the contents claim, on a total loss, the public adjuster is still working hand in hand with the insured, because only the insured knows what they lost. So
Right.
we'll take the legwork, but we certainly need input from the homeowners to define and determine what it is that they lost, so we can accurately assess what that is. And that's why it's important, because on a total loss, we're walking into it, and unless there are photos and videos and the like that help support certain things, no matter what, the homeowners are going to have a very significant role in determining what that inventory looks like, helping price it and finding depreciation and links to support it, and providing information to the carrier in support of it. That can all be done by somebody else or by the homeowner, but the homeowner certainly has a huge role on every contents claim. That
Yeah,
just
so
can't
I
be
think,
ignored.
I'm sorry, I think for most of us, the concept of how depreciation works with a personal property inventory, I can get my mind around that. You know, it's you know, you've got your list, and hopefully you all know this already, but United Policyholders offers on our website a couple of tools to help you with your inventory. We have a sample inventory that you can download, and we have an Excel spreadsheet. We've taught quite a few classes over the last year on specifically on your contents inventory. But I think on the dwelling side, it's a little more confusing. So we're going to talk, we want to make sure we've explained the whole concept of depreciation, why it matters. Obviously, it matters because it affects how much money you collect on your claim. So we're gonna make sure we get through the terms so everybody kind of has a good feel for the topic, and then we will go into depreciation, how it works with a dwelling, and then we'll go into how it works with your contents. But these are a few things I want to make sure that everybody really absorbs. It's a bit of a wild, wild west in a way, because there's no official standard for how much insurers can depreciate your property. And it can be hard to pin down an adjuster on how they apply depreciation, how they calculated it. But because those calculations affect your pocketbook, we encourage you to challenge their valuations if they seem unfair. There are some items that should not be depreciated. Sandy, can you explain why are there things that shouldn't be depreciated? What is it about them that makes them not depreciable?
Yeah, well, so if you consider the items that you have in your home, like say for instance, you've got a television, say you've got a 50-inch television, and it's a Sony and it's 3 years old. Well, you can go and you can buy a new television, a Sony that's basically the same size. They upgrade the models, every so often. So you can buy a substantially similar item on the open market for replacement cost and get it. But if you have a 200-year-old, armoire from your grandmother in France or whatever, you can't simply march on down to, Macy's or wherever and buy something like that. So the only way to buy certain items like antiques, fine art, certain pieces of jewelry that aren't mass produced would be to buy them on the secondary market. So, however you would, if you were going to go buy an antique, that was like the armoire you lost, that is the replacement cost. So really the replacement cost and the actual cash value are exactly the same thing, because if it's going to cost you $1,000 to buy something on from an antique dealer, that's a replacement cost, but it's also the actual cash value, because that's what you could have sold your piece for directly prior to the fire.
Yeah, and we're going to explain a couple of things that adjusters sometimes do that that are actually not permitted. But one tip we give here is to ask your adjuster to give you a copy of the depreciation schedule or method that they used if you catch any ways in which they have excessively or improperly depreciated your stuff. And we got a question before the program today that's kind of a classic one of somebody who had their adjuster apply across the board depreciation to their whole list, just one massive 50% depreciation, and that is not allowed. And because condition matters, anyway, so that's a link to a publication on our website that you can refer to after tonight's program for if you have a question. So just a reminder, as we said already, depreciation is subjective and negotiable. There's no fixed standard. Each insurance company has their own, but it has to be fair. That's why we suggest that if your adjuster is improperly depreciating, you ask them to give you a copy of whatever their depreciation schedule is. Math mistakes are common. And as you heard from Sandy, some items don't lose value or decay or become obsolete over time and should not be depreciated. Very common for adjusters, overworked, busy, too many files, traveling, whatever, to try to shortcut. And sometimes their intention is good and that they want to cut you a check as quickly as they can. But sometimes their intention is just to get in and get out, and they will do what the adjuster did in the 50% example and just say, okay, we're just going to apply 15 or 20 or even 50% depreciation across your entire claim, not allowed. And in that,
if I could, Amy.
Yeah, sure. Go ahead, Chris.
So on that, to me, you're absolutely right that they can't do it across the board unless the insurer wants to agree to it, and then you guys can come to a negotiated amount to say, hey, to assist us, we'll agree to perhaps a 30% across the board. The most important thing that I think to do, though, is to reach agreement on what the replacement cost value of your entire claim is. And I think it was mentioned before that if you're so underinsured that your ACV payment is at the RCV limit, then the claim is over.
Right.
The good thing is you get paid at your limit. The bad thing is you're way underinsured. But the most important thing is to reach agreement with the carrier on what your replacement cost value is. And then you're open to say, hey, can we agree upon an across the board depreciation percentage? But they can't do it unilaterally and then say that that's the way it is. You
Right.
certainly do have that option to oppose or continue the dialogue.
And we had, just to add to that, did have somebody write in and say that their adjuster depreciated 15%. If you feel like, your property is overall depreciated more than what they're offering you, then if it's in your favor, obviously it's in your benefit to accept it. Someone else wrote in on something that we don't have on this slide deck, but it's very important to bring up at this point, is that depreciating an item that existed before the fire to zero is inappropriate. We have an attendee here wrote in here and said that they had tools and they were like 20 years old, but you have a hammer or something like that, depreciating to zero is inappropriate because that item does have value. I mean, even if the value is done. So there is really no situation, unless something is just completely like ruined before the fire, and for them to depreciate to zero.
Yeah. So, I mean, as you can hear, there are a lot of different scenarios, that you may find yourself in, depending on your adjuster that's currently assigned or the previous adjuster that you had. And, all of our guidance is designed to help you come out on the other end of this situation as painlessly as possible with as much money from your insurance policy as is available. So a little bit of flexibility is normal. A little bit of give and take is normal, but you have rights, and we're here to explain them to you. If you feel like your adjuster is improperly, excessively depreciating, and you have not been able to succeed through polite assertiveness, we recommend always the next step is to file a free request for assistance with your state Department of Insurance. And later in this program, we will give you the links to the agency in your state that you can seek help from. So we're going to get to depreciation and your dwelling claim. And this is a really nice basic image. Sandy, you want to just explain this visual?
Yeah. So the most important thing that Chris was talking about for your dwelling claim is exactly the same thing as he was talking about with your contents. The number one goal that you guys need to be focused on is what is the current cost to rebuild the home you lost. Okay, that is replacement cost. Everything else flows from there. Okay, so in general, your policies provide replacement cost up to your policy limits, and then subject to depreciation until they're repaired or replaced. So we can get into it a little bit more, but there's a couple of ways of measuring the actual cash value of the home. But in general, it's replacement cost. Okay, you need to get that figure number one. And then reasonable depreciation for items that actually deteriorate or wear out. And we can get to that a little bit later.
Okay. So Chris, do you want to just sort of explain this slide here?
Yeah, so the claims process is your home has been destroyed using the wildfires as the example here. And the carrier will send out an adjuster or a consultant to try to determine what it costs to rebuild your home. You, in my humble opinion, should not rely solely on the input that you receive from the carrier. You want to know what it truly costs to rebuild the home. and you can find somebody that will prepare that estimate for you, or you're going to go to a reputable general contractor if you truly want to rebuild your home, and they're going to tell you what that cost is. But the scope is what's important, I think, is what's reflected in here. And oftentimes what a carrier will do, or the adjuster, he'll prepare what's called an Xactimate estimate. And it can be a 30, 40, 50, 60-page document that breaks out every room and every widget in every room by material costs and square footage and the like. That's kind of that's your scope, and that's how they determine what their loss is. And they'll probably depreciate certain things too. So they will talk to you as the homeowner to say, okay, when was your roof replaced? Did you do any remodeling? When the last time you painted? Did you put carpet in? And they use the information that you share to apply depreciation. So if you had remodeling that was done 2 years before the fire, your depreciation on certain things should be less than had you done no upgrades or improvements over a 10, 20-year period. But they're going to try to tell you what it is to cost to repair your building based upon this software program. Please remember, the adjuster and your carrier are not going to rebuild your home. They're just telling you what they think it might cost. And what we've seen here in Colorado is there are some carrier and carrier representatives that are pretty accurate in providing estimates that capture those costs, and there are some that are questionably off by a factor of 1 or 2, and that should be concerning. But the bottom line is you want to know what your damages are, and you want to rely on somebody that can put that estimate together versus just the carrier putting it together. You want a proper scope.
So
Thank
you. Yeah, thank you, Chris. Okay, so this is typical policy language that explains that the insurer will pay no more than the actual cash value until actual repair or replacement of the dwelling is completed. Now, as we've said, there are situations where insurers don't enforce that. Sometimes if you're very underinsured, they may cut you a check for your policy limits, hoping that you will go away. That can happen. But typically they're going to do just what Chris laid out. They're going to prepare a scope, hopefully, and an estimate. We encourage you to trust but verify and have a construction professional or claim professional assist you in making sure that what the estimate that the adjuster has given is accurate. And then they will, so Chris, how does depreciation factor in here?
You bet. And before I go into that, I just also want to say, so if you have it's important to know your policy as well. Okay, so this is an example. Thank you, Amy. So this is an example that I can go over with everybody. So this is an estimate that was prepared by an adjuster on behalf of a carrier. And at the time, this is based on the limit that was in effect at the time. So these homeowners had a $418,000 limit. They had a $278,000 base limit, and then they had an extension. So you guys are going to need to know what your policy provisions are and whether or not you have extended coverage. They're only going to pay your dwelling limit on the declaration pages, and they won't pay the extension until that cost is incurred. So this is an example where the carrier actually captured the cost to rebuild the home. I'm going to just round out at $700,000, but they only had $418,000 in coverage. So what this carrier did is wrote the estimate that basically acknowledges that they're going to get their limit. But you'll see here, this is depreciation. So if you go down the list, you'll see where the less depreciation is 168,000, and that's approximately 24%. Here, we are going to use this to our advantage because 24% is not an unreasonable amount. The home was built in 1990, and this is an example of these homeowners actually put in an extensive remodel a couple of years after they bought it. They called their agency and informed the agency that they were making these repairs, and they wanted the coverages to be increased, and they rightfully should have been. Recently, because we actually approached DORA, which is the Department of Regulatory Agencies here in Colorado, providing them with facts that the carrier should have actually increased the limits, we just recently learned that the carrier is doing the right thing and is going to increase the limits. So in this case, they have a general contractor. They know what their damages are. They know what it's going to cost to rebuild this. So we're suggesting to them, your $700,000 is your estimate, but we respectfully disagree that that's an accurate RCV. We believe the RCV is $1 million. If we apply your 24% depreciation, which we will accept, the payment should be far greater than the 696, and that's the new limit without the extension. So the depreciation applied here is 168. In this example, before anything else happened, the carrier was only going to pay 417,000, but they were withholding the 168. That's the amount that they were overinsured. So I don't want to go too far, Amy, and I'm happy to address if there's specific questions. But this is an example where the 168,000 was the depreciation. These homeowners only received $278,000, and the carrier was going to hold 139 until the repairs were actually done to get to the 417. But the carrier has now since done the right thing and has increased the limits. But they were able to do it because they actually know what their damages are, and they have a general contractor that submitted an estimate. So they know what their RCV is, and we believe we know what their ACV is. So this is an example of something that is favorable, but early on it wasn't. Early on, they were faced with building a home for $1 million and only getting 400,000 from the carrier.
Yeah. So Sandy, 24% depreciation on a dwelling, does that look standard to you?
It depends on the dwelling, you know. If you've got a newly built, say, you know, home in a development that was just finished last year, then it would be probably excessive. If you have, you know, an old house that needed updating, it would probably be light. So it's important to look at the items that they depreciate, sort of line by line. And I know it's pretty daunting to look at these estimates, but it is really important to see what they're depreciating. And it should only be things that wear out: paint, carpet.
What about studs? You know, I've heard studs are hidden behind the walls. They're not exposed to the elements, so they shouldn't break down. They shouldn't be depreciated as much as, say, paint, right? Exterior paint.
Yeah. You know, in California, at least, we're not seeing carriers depreciate studs. They've pretty much learned their lesson on that. But if they do, you know, they should give them a life of expectancy of 150 years, 200 years. Yeah. Because they don't wear out. So yeah, that's a good point.
So, and then, if you have a replacement cost policy, you know, and if you're properly insured, and I know that second part is a big if for a lot of people, the depreciation can be a temporary problem, right? Because once you spend the money, you can replace, you know, you put proof of the expenditures in, and then your insurer should pay you the difference between their depreciated value and the replacement value. Of course, a lot of people are underinsured, and also a lot of people need every dime to actually get the project going, you know, to get the builder working, and, you know, get the builder so that they can buy the supplies and get the project going. And you know, we can talk about some of the areas where there typically is fighting before we get to California. There's one, and so it does matter how much the insurer has depreciated your dwelling. Even if you are, it matters if you're underinsured. It matters if you're insured, because it affects how much you're going to collect and when. United Policyholders has been fighting all over the country on behalf of consumers on this topic of depreciating labor. So very often, and this is just a fight between insurance companies and policyholders and policyholder advocates. Insurers often will try to apply depreciation to the cost of labor on a project. And in our view, that's not fair. It's not right. You know, people's labor doesn't decrease in value. Chris, how often do you get into fights about labor depreciation, would you say, with an adjuster for an insurance company?
Frankly, Amy, I mean, it's come up, but it's not that frequent.
Okay,
It's not an issue. Some do on other claims, but on these wildfire claims, it's not come up as an issue. And on the dwelling portion of the claim, to me, if you reach agreement on the RCV and you're truly going to rebuild your home, even if it's excessive, you're going to get it because you're rebuilding. When it comes to the contents, totally different story trying to recover recoverable depreciation. That's a far more difficult battle in my mind. On the dwelling, if you reached agreement and they depreciate it, even if it's excessive and it's not supported, you're going to get it if you've reached agreement on the ACV and you truly rebuild. If your situation is different where you may not rebuild, then there are other factors to consider.
yeah. And I want to recommend, not only have we hosted classes, webinars on putting together a contents list and valuing your contents, we've also offered, and you can watch recordings from our website, we've offered classes and webinars and clinics on getting your dwelling replacement scope of loss right and correcting mistakes that adjusters may have made on your dwelling estimate. So Sandy, can you characterize what is one of the biggest mistakes you see insurance company adjusters make when depreciating a dwelling, applying depreciation to a dwelling?
You know, most of the time, they're guessing. In my opinion, they're guessing. They'll take, sort of talk to the insured, get the overall value of the overall age of the house and sort of randomly apply it. If you talk to a policyholder, very rarely do you find that they actually, especially in California, they're required to actually line by line be able to justify how they applied the depreciation. We have a little thing on that later, but never do you get a policyholder saying, "Oh, well, my adjuster sat down with me." I mean, sometimes they do, but rarely. This is the biggest mistake. They don't sit down and say, "Well, when was the last time you painted the inside of your house or the outside of your house? When was your roof replaced last? When were your hardwood floors put in? Did you remodel your kitchen?" All of those things, that I would say that's the biggest mistake, is that they don't take the time to get that information from the owners of the home, who are really the only people who have that information at this point.
Right. Is 24% kind of is that in the ballpark of what you see as terms of depreciation applied to a dwelling?
Well, like I said earlier, it really is, it's individual to every single loss. So
based on the age of the home,
the age and condition,
the materials, and okay.
Yeah.
I just curious if there's like sort of a ballpark, because for contents,
I don't think there can be.
No ballpark. Okay. All right. Okay. Let's get to depreciation and your contents claim. Similar diagram to what we showed earlier, just to try to illustrate it to you. We often use the example of a couch. And we look at the cost to buy the new couch, that's the replacement cost, RCV. And then the actual cash value would be the value of that couch an instant before the fire, or what you could have sold it for on Craigslist, for example, the used price. That's what you're owed until you repair or replace, as long as you have replacement cost coverage. And the reduction in what your insurer pays you, which generally should be temporary, is going to be for the wear and tear, right, to account for that. And the reason we often use a couch is, I'm going to make you dizzy for a second. I want to show you, we're going to come back to this one. This is a really good illustration of why condition is so important and why age shouldn't determine what the insurance company owes you. Thank you. You take the same couch, bought, let's say, at Macy's, and an elderly couple has it they don't have children, they don't eat popcorn on it, and so at 5 years old, maybe it depreciates 20%. But you take that same exact couch in the living room of a family that has kids and pets, you can see them having a great old time. The baby, magic markering, crayoning on the side. That same sofa, because of the way it's been loved and used, could be depreciated more like 20%. And that's why we use this example. And that's why, we encourage people to remember that condition matters.
Ooh, Amy,
They tend to look for shortcuts. I'm sorry?
You froze up for a minute there.
Yeah, they tend to look for shortcuts. And one shortcut is trying to depreciate everything across the board or just by age without considering condition.
And if I could, Amy, so
yes, please.
That very example, now say that you have 1,500 to 2,000 line items in your entry or your spreadsheet or your inventory. Look at that significant difference as to what a true proper supported ACV might be versus what a carrier may try to do. And we've seen many where they take, if something is like 25 years or older, they'll take 75% depreciation. We've seen 80% depreciation. And that's just truly, that's wrong. That's excessive. Should depreciation be applied? Absolutely. But it's got to be based upon the circumstances of that given insured. And there are examples where, let's say you have things that are extremely valuable, of high quality, and you store them and you use them once a year on holidays, but they happen to be 10 years old. The example that Amy showed is support that depreciation could be 15, 20, 25% maybe, but a carrier is just going to look at the age and they're going to try to depreciate it. But you have to look at the quality of the product, how it's used, much like the example, the age, the condition, and again, if you store things for a period of time and you rarely use them, that supports a very lower amount of depreciation. All those factors need to be considered on every bloody line item in your inventory. And that's why we believe it's important for the homeowners to tell them, provide what an appropriate ACV is. Because one of the requirements is for you guys to provide an approximate age for every bloody entry. So if you're taking the time to do that, also try to figure out what the ACV would be and submit that to the carrier. That's your claim. Don't let them tell you what your claim is.
Mm-hmm. Good point. We actually, we just got into talking about contents. We kind of left dwelling behind, but we got a question that is very relevant to dwelling depreciation that I want to throw out to the two of you. We've had COVID has brought about material shortages and then price increases, and that combined with, if you lose your home in a wildfire, where a lot of other homes were impacted in a small region, that you have both something called demand surge, which a lot of you I'm sure are familiar with, where prices go up because demand has gone up. But we have sort of a bit of a perfect storm going the last few years, where we've had a lot of wildfires creating a lot of demand for lumber and construction materials and services. And we've had COVID, which has interfered with some supply chains. So Chris and Sandy, I'd like to hear your thoughts about how these increased costs figure in with let's start with a dwelling claim, and how does that come into play? Sandy,
would you like to go?
Oh, sure. Well, I don't actually, this isn't really a depreciation problem per se. It's a valuation. And so I can't reiterate enough how important it is to know how much it would cost to rebuild the home you lost. So at today's prices. So it is what it is. And, unfortunately, the underinsurance aspect is the part that's the problem with this scenario. And it's a scenario that a lot of people are facing. I think you have to bite things off, one bite at a time. And the first thing to do is make sure you have a good solid estimate. And if it's higher than theirs, you need to deal with that issue first and then go back and negotiate the depreciation. They're two really separate situations, but I can't reiterate how important it is to know what it would cost. And a lot of people, I mean, we understand, we got some questions about, rebuilding different houses. It's not what you actually rebuild, it's what it would have cost to rebuild what you lost. And as long as you spend the money, so say it's gonna be $500,000 to rebuild the home you lost, and you get an agreement on that. And it was, 2,000 square feet, and it had, whatever, this and that, and you decide to build a house, maybe that's a little smaller, 1,500 square feet, but you put it a little nicer, something in this and that, you're downsizing. You're absolutely entitled to do that. You just need to spend the money to get the withheld depreciation back, but it's all based on what it would have cost to rebuild the one you lost.
Right. And again, so not only are we trying to give you information to make sure that you get the least amount of depreciation applied so that you get the most payment out of your insurer, but we want to kind of reinforce how important it is that you keep your eyes on the prize, which is what is the fair replacement value of your damaged or destroyed property. And you heard Chris talk about that, how important it is to get an accurate scope and estimate to replace the home you had. Same thing goes for your contents inventory. We also got a question that has been coming up a little bit here and there recently about when the price gets determined, when the whether the insurance company owes you the cost of putting the house back or replacing your contents the day of your loss, what it would have cost that very day, or whether it is what it would cost at the time you replace it. Now, in all my years of doing this work, that was kind of a new one on me, and I think that insurers would try to play that game and say, oh no, it's the cost to replace as of the day of the loss. I think with all the fires and there being more and more, some insurers are looking for ways to save money, and this may be one of those ways. Sandy, what's your thinking about that?
Well, first off, some of it's policy specific. Some of the policies dictate when the loss is evaluated. California specifically has a statute that says that the actual cash value is determined as of the day of loss. But then it goes on to say, so in general, the ACV payment is based upon the loss date. In California, it goes on to say, if they withhold depreciation, then they have to, after you've repaired or replaced, they have to pay the difference between what you actually spent and the actual cash value. So that would be where the increase in the building costs come into play. So I can't really speak for what the laws are in other states. In California, I feel like we're pretty protected on that. And there's some policies. I don't know, Chris, if you guys see those there's some policies that talk about it. Some policies that talk about surge after a disaster. They're trying to limit that a little bit, price surges.
I haven't seen that, but those that are writing in with the questions, they're valid concerns, and they're valid as part of the claim, because you're trying to figure out what the cost is. And like in Colorado, the recent ones, if you have a loss that happens in October, you're not immediately going to start rebuilding. You can't start until probably the following year. So you have to determine what the cost is now. I'm not seeing a lot of pushback from carriers if you can support what those costs are. And again, the double whammy is if you're underinsured and you're going to hit your limit, whatever it is that might be over that limit, that's still going to fall to you. That cost doesn't go to the carrier. If you have enough within your limits to meet those increases, you should be okay. And I think what we're seeing is there's always going to be the difference there. There are some people that are going to truly rebuild and they have a general contractor in place, and there are others that might not have made up their mind yet. and they need to figure out that you need to determine what your loss is, and you need to determine what the carrier or reach agreement on that is, so you can make an informed decision as to what you want to do. If you want to rebuild there, rebuild somewhere else, or purchase something somewhere else. But you can't really do that, in my mind, until you know what you're entitled to from the carrier.
Yeah. Yeah, I'm an attorney, so I'm always going to think about fairness arguments. So I would say, if you are in a situation with an insurance company where they are asserting that they're only going to pay the replacement cost as of the day of the loss, and prices have gone up considerably since that, that would make it functionally impossible for you to replace that asset. And so, that would be a situation that I would bring to the attention of the Department of Insurance, and or even take it to an attorney. Because I think, it's deceptive for an insurer to sell replacement value coverage and then have it limited in a way that's not realistic. Sandy, can you walk us through the policy language that we're looking at here?
Okay, so this looks like a State Farm policy to me, for coverage B, which is personal property under this policy. These are two different types of coverage, and generally you choose this coverage when you are purchasing your policy. Okay, and so B1, limited replacement cost, it talks about we'll pay the cost to repair or replace the items. And until the repair or replacement is completed, we'll only pay the replacement cost less depreciation, which is actual cash value. Once you replace it, they'll pay the difference. And then it talks about, we talked about this earlier, the antiques and the fine arts and the paintings. But then B2, this is a provision that sometimes takes people by surprise. Because this isn't what we call an ACV policy. This one says we're only going to pay you the depreciated value of the items you lost. Generally, that coverage is in exchange for a premium credit. So sometimes it's sold in cases where people are looking for, bare bones policy that costs less. But that's basically what's going on here.
And that's why we're offering tonight's program, because this is not for the faint of heart. Anything to add here, Chris?
Yep. So part of what's important, again, guys, is when you're looking at this, and in this example, if it's a State Farm spreadsheet and they're going to give you the ACV payment, they're going to ask you to line up. Let's say entry 1 is for the couch at $1,000 and they depreciate it by 10%. I'm sorry, let's say they depreciate it by 25%. They're going to give you $750. Your inventory says the couch is, let's say we agree at $1,000, but you depreciated at 10%. So you're saying that they should give you $900. So there's a $150 difference. Again, for every item or entry in your spreadsheet, that difference is significant. When they ask you to submit the receipt, they're going to use their spreadsheet, but yours is different, right? They're going to give you the depreciation they've applied, not what you've applied. Who's right? And you're going to argue, or at least I would, that it's your claim. You want to use entry 1 for yours to get the depreciation, and so they should have withheld less. You need to make sure you understand what it is that you're submitting and what spreadsheet you're using when you submit receipts. Because there's going to be two of them. There's going to be yours and there's going to be the carriers.
Yep. Okay. So, Sandy, this is obviously a State Farm policy. And this is what your declarations page would look like if you had opted for those two options we just saw on the previous slide. You opted for B1, limited replacement cost. So again, if you have not been to any of our previous classes or webinars, you can go back and watch or review how to read your policy, and we give good guidance on figuring out. This is a declarations page. By now I'm sure most of or all of you are very familiar with your declarations pages, but this is the map to what you have in your policy. Okay, here's a renter's policy example. How might this be different, Sandy?
You know, renters policies are really basically the same as homeowners policies, except they don't insure the structure. So really, this is just for personal property. And so this is just pointing out that if you do have a rental policy, the contents are handled in identical same way as a homeowners policy.
Would you say, can either of you say whether it is more common to see ACV only on a renter's policy for personal property?
Well, if the homeowner has a rental policy, their personal property limit will be much less because most of the possessions in that are not theirs, or they wouldn't have a considerable amount. But if you're the tenant, again, like even the homeowner, you want to be properly insured, and you want to know the value of your possessions before you have a loss. I'm not sure that answers the question, but
yeah, I'm just asking if Sandy, if you have seen, or Chris, just like a lot of manufactured home policies are ACV only, do you see that with renters policies as well? And I'm hearing you say,
you know, what I would say, what I'd say we see more on renters policies is just straight underinsurance. You know, somebody goes out and, you know, they say, oh, I need a renters policy, and somebody sells them, you know, $30,000. I mean, it happened to my own kids. I mean, they've been listening to me forever. And when I'm like, okay, you guys, you need, you know, a renters policy, they just went and bought something. And I'm like, well, I'm just going to tell you guys that $30,000 isn't going to get you down the street because, you know, what, you know, their furniture and all of that stuff. So
it adds up.
Yeah.
So, okay. But basically for renters, it's going to be a very similar process, similar approach. And we're recommending, you know, that you take a proactive approach to valuing your possessions so that you improve your chances of getting a fair payout. So we talked earlier that depreciation is subjective, meaning there's not one set chart for how much every item should be depreciated. And so it's subjective and it's negotiable. And that's where you can really make a difference on your own behalf. If you can find places, examples where an adjuster has overly depreciated your property, either by characterizing it as in worse condition than it was or older than it was, or by doing basically just putting an excessive figure on the depreciation. So Sandy, you want to explain this slide?
Well, it would be easier to explain the slide if it sort of matched up a little bit, but pretend the items are the same top and bottom. Basically, the top bit is what someone policyholder would turn in, you know, about each item. And then the bottom is what the insurance company most often returns to you. So this is somewhere. So we could probably fix our slide a little bit, but we didn't have time. But what you want to do is compare what you've turned in with what they gave you. Like Chris was talking earlier, you want to make sure. And we've had some comments from people saying that, well, I turned in a Honda generator on my list and they came back with a home light generator, which is worth half the amount. And you see certain insurance companies are known for doing that, especially from what I've seen in California. So you need to make sure that what they're putting on their list is the same item that you were claiming, that you know, the same item that you lost. So I think that's what this is intended to illustrate.
Okay, so and then Chris, looking at this Liberty Mutual sample here, and the circle around the depreciation column, this looks like gosh, almost 50%.
Well, certainly on like 19, the necktie it's 50%. But I would also like to stress to the homeowners is details, 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 because this is your claim. And if you say shirt, they're going to find a shirt that might not be exactly what you had. That's why it's important when you submit your list. You know, is it a couch? Is it a leather couch? Is it an upholstered couch? Is it a custom couch? You know, is it a high-end couch? The more you provide, the better it is for you going forward, because the more generic you are, the less likely you're going to get an accurate price or a price that might match what it is that you lost. So we clearly say you don't get to replace an upholstered couch with a leather couch, but you are entitled to replace what you lost with something that is of like kind and quality. And the more details you guys provide, the better. And looking at this example, Amy, I mean, the 50% for the quality, if I look at 19, I don't see the age, but am I supposed to go up here somewhere to see a tie to see the age? Because at 50% and you have a necktie, if you only wore it once, 50% would be excessive depreciation.
Yeah.
If you've had it for 5 years and you wear it every day, 50% might be okay.
Okay. All right. So it really very much does depend on the item. And as Chris said, the more detail, the better. And look, we at United Policyholders really understand the pain that is the contents itemization inventory process. I mean, we have been in this, in this space for 30 years. We have many people on our team who have lost homes. We know that it is really hard to force yourself to put the time in to listing every single thing. And I often talk about this, how, your heart, in your mind, you've got your heart's trying to protect you by helping you forget, I think, things that are painful, right? That's normal. We kind of try to put sad things out of our minds. And the process of having to do an itemized contents inventory kind of is, it's opposite to what your heart's trying to do, right? Try to help you move on and forget. And there's your insurance company constantly forcing you back into that most painful place of remembering all the things that you have lost that were valuable to you. But that's why we're here, is to try to give you kind of strategies and ways to take a business-like approach to this as much as you can, because again, it's your money, it's your assets that you are here trying to get the money to restore. And so, we offer as many tools as we can offer to make it a little less painful. And not just tonight, but our previous workshops where we did a contents intensive, and you can watch that. And then we have all these tools for free on our website. And if all of this is just too much for you, you can still get professional help. Many insurance companies will give you a contents specialist to help you. But even so, even with that, as Chris said, it's, you have the biggest stake in having your assets be accurately valued. And so, it is, I just recommend taking advantage of all the free help that we offer to get your claim fairly valued and not overly depreciated. Okay. Is there a time limit to collect replacement cost benefits? Well, we say here in California, but in every state there is. So Chris, can you just generally explain how most policies limit how long you have to replace items and make a claim for replacement cost benefits above what you were paid for ACV?
Yeah, so I believe with the assistance of United Policyholders, they were instrumental in getting some changes to homeowners in 2013 or 2014. And you now have 365 days to submit an inventory, and you have up to 2 years for ALE or additional living expenses. I believe in Colorado, you have 365 days after your additional living expenses expire to seek replacement cost benefits or get your depreciation holdback. So you're going to have ample time. And again, I think we've shared that this is a very painful process in trying to recall everything that you had. For those who have suffered losses, like last year, some in Colorado are coming up upon a year. Some haven't prepared their inventory yet. Many have. But even if you haven't, or if you're still doing it, there's sufficient time to do it. And then you still have plenty of time to recover the depreciation. But to make it even a bit more difficult is you're going to be having, unless you've got your limits on an ACV basis, you are going to have to be submitting receipts, and you're going to be matching them up. The carrier is going to suggest you need to match them up to entries on the inventory to figure out what that difference is and what they're going to pay. But you have, I think, 365 days in Colorado after your ALE expires.
Sandy, I think, well, we've done better in California than we have in other states in terms of giving people more time to collect their replacement value. What's the rule in California?
Well, yeah, it's part of 2051.5, which is really, really good law as far as I'm concerned. They have 36 months from the date of the first actual cash value payment, not to be confused with an advance. And this is, for structures. Very rarely do you get structural advances. Sometimes you do. But so 36 months from the date of the first payment, but the law in California allows them to extend that. And they are actually required to extend it. Make sure you ask in writing. That's the main key. Make sure you ask for an extension, ask in writing, and make sure you get a written response from them.
Yeah, and we know in Oregon, because we helped get the law through, it doesn't apply to 2020s. Technically, it doesn't apply to people who lost their homes before the law changed in Oregon, but it sets a standard of care. And so in Oregon, you have the same 3 years, but again, not technically, but you can say to the insurer, I cannot replace everything within the time limit. I need extensions, and the law going forward says that I get them. And in Colorado, it's not 3 years, but it is a full year after your ALE benefits expire. And again, this is for you to get that difference between what they paid you for ACV and what they owe you, right? And that's what we're talking about here, RC benefits, right? Those extra buckets of money that are the difference between the replacement value and what they already paid you, okay? There's no specific statutes other than the new law in Oregon. Your policy will tell you what the limits are. But again, there's never any harm in asking for extensions, and when you ask for extensions, and we have sample letters in our library, all free for you to use to say and give reasons why, you've been diligent, you've been trying, but fill in the blank, I'm sick with COVID, or, I haven't been able to, the stores it's very hard to get to the store, or whatever it is, or reasons why you haven't been able to replace items, and just saying, I need more time, and this is why. There's never any harm to asking for extensions. And if your insurer says no, then you have free help from your state Department of Insurance to get extensions, and getting extensions is generally a lot easier than getting adjustments of dollar amounts. Sandy, do you want to explain what this California regulation is?
Yeah, so this is part of the California Fair Claims Settlement Practices regulations. These are fantastic regulations in California protecting insurance consumers. And certain states do have model regulations that are sort of close, but this one talks about depreciation. And this is what I was talking about before, about how every time they adjust something, because they call it betterment, that's kind of an old term, but depreciation, they have to have a justification for that adjustment in the claim file. And so they can't just put the numbers, and everybody does. I've rarely seen sometimes I see a few lines, in cases that go to litigation that I look at, but they have to be able to justify the amount that they took, and they need, this kind of sets it out. And there's if you go to the next slide, there's a second part of this that gets in even a little deeper. And it talks about, like kind of inequality, and talking about how they're in California, you're not allowed to depreciate labor. And I know that's the case in other states, certain states as well. And there's some litigation going on in a few states about that right now too.
Yeah, and we got a couple questions. We got a question from a couple folks in Colorado, where their insurer is refusing to extend that time frame for collecting replacement cost benefits. And this kind of goes to reasonableness. Is it reasonable that they are refusing to give you more time to collect the full policy benefits that you're entitled to, given that in this example, the spring and summer, the roads were washed out due to the burn scar, runoff, and rain? That's a very legitimate reason that would prevent things from getting delivered, et cetera, et cetera. So, a lot of our guidance is, it starts with helping you be your own best advocate. And then the next step is getting help when your self-help doesn't work. So if your insurer is being stubborn, and you can go to the Department of Insurance, if they can't help you, then your next stop is to go to a professional if there's enough money at stake, like a lawyer, for example. Because if the insurance company is behaving unreasonably by not extending a deadline for you to collect your replacement cost benefits, that a lawyer might say, hey, that's unreasonable conduct. A jury might find that unreasonable conduct. And if there's enough money at issue, you may be able to hire a lawyer on a contingent fee basis, which means you don't pay them hourly, that you pay them a percentage of what they recover on your behalf, just like a public adjuster would do. And you can try to go that route, because if the insurance company is unreasonably refusing to honor their obligations under the contract, that can be something that you can take to court. It's never a guarantee either way. If the contract is very clear that that's the deadline, but generally speaking, insurers are obligated to be reasonable. So if they're being unreasonable, then they can be held accountable for that. Chris, anything more on Colorado with regard to deadline extensions? Do you find sometimes you're able to get insurers to extend deadlines? Is that one of your tricks in your bag?
Well, I'm not sure it's a trick, but again, if you do it in advance and you can support the reasonableness of the request, the carrier should extend. There's no prejudice not to, right? They're just trying to deny you benefits if they don't. Right. Certainly, if you've reached agreement as to what it is, and you're simply asking for a bit more time, and if you have been diligent, or if the repairs to your home aren't completed, therefore you can't purchase things to furnish your home, or it doesn't make sense to, it's all the more reasonable to request the extension and almost insist that they honor that and extend it. But you got to be reasonable in your request, give them advance notice, and be able to support it. But to me, if you do that, the extension should be granted.
Yes.
And I haven't seen where they haven't. If there's an example of somebody, a homeowner now that is encountering that, I believe that would be wrong. Certainly if it's from a 2020 claim.
Yes. Okay, so we've given you here the Colorado Broad Evidence Rule, which says this is just a legal principle that you have to look beyond just wear and tear and market value, and look at all the facts and circumstances which would lead to a correct estimate of the value of the particular items. That's the law in Colorado. Right now in Oregon, there's some work being done to try to prevent insurers from depreciating labor. Kind of heard that Chris doesn't see that as a big problem on a lot of his files. Sandy, you see a lot of situations where the depreciation of labor is making it hard for people to get their claims resolved and get their properties rebuilt.
I don't,
Okay.
because it's very well settled in California, so they seem to know it.
Yeah. Okay, in the state of Washington, we've given you the standard there about holding an insurance company responsible for accurately applying depreciation, not overly depreciating. And again, that same kind of standard that depreciation should be determined by physical deterioration and obsolescence, not just age. Okay, and I want to say that this deck will be available on request. You just have to email info@uphelp.org, or we will probably be posting a link to it as well on our website. Here is the California Department of Insurance website and their toll-free number. If you are in need of help getting deadline extensions or dealing with an unreasonable insurance company or adjuster. This is the Colorado Department. We work cooperatively with state departments of insurance, and often we'll have somebody from that department on one of our classes. We have a class coming up for Colorado folks on September 29th, where we will have an officer from the Colorado Department of Insurance answering questions with us. We've done programs with the Oregon Department as well. They offer a toll-free number for consumer assistance, and so does the Washington Department of Insurance. These are all four of these states have their departments of insurance have pretty good reputations as being able to help people with claim problems. Now, they're not going to be your free lawyer. They're not going to be your free public adjuster. They don't have that kind of people power. But we find very often that filing a complaint or request for assistance with one of these state agencies really does get the insurance company's attention and very often gets them to behave better because they are subject to fines and penalties by those state regulators. So they're particularly can be helpful with getting deadlines extended and things like that. Not so much remedying under insurance, but definitely getting uncooperative adjusters to behave better and get you more time to collect what you're owed. So this is our library that we have for California 2020 wildfires. We have one for Colorado, we have one for Oregon, and we have one for Washington. We've got the following upcoming events. I really encourage all of you to take advantage of what we offer. It's all free. Hopefully you know by now that we are very deeply legit. We are not here to sell you anything or convince you to go one way or another. We are here to give you reliable data points so that you can make the best decisions for yourself and your household. We know a lot of people at the 1-year anniversary have a lot of emotions come up, especially this year when there's smoke in the air and a lot of areas where folks have lost homes. So it can be very difficult. And one of the things we offer, in addition to the technical information that we are giving you tonight, is the survivor to survivor forums, a very kind of safe place where you can be with other people in your situation. People who are in the same situation with you now walking the road you're traveling, people who were in that situation years ago and are now kind of came out the other end of the tunnel, but have a lot of not just empathy and understanding, but also practical suggestions for things like pricing items and having pricing parties and things like that for dealing with your inventory. So we've got a couple of those coming up free of charge, and the registration links. We will be having a Q&A with Sandy answering questions coming up next Wednesday. And then Wednesday, the 29th, we will have another one, as I said, for Colorado, where we're going to have our Colorado coordinator, Carrie Waite, along with Tracy Garceau with the Colorado Department of Insurance. If you forget everything that you've heard tonight, then you can go to our website. These you'll find under the events tab there on the navigation bar. You can find the information on those events that are coming up and how to register. I already mentioned Survivor to Survivor. We also can help you find other people who are insured with the same company as you in your area. So we do our best to reach everybody that could use what we've got to offer. But we really appreciate it when folks let their friends, neighbors, coworkers, and anybody that they encounter who may have had a loss and might not have heard of us, to encourage them to sign up free of charge. I want to thank our Colorado funders that are making it possible for us to be serving the beautiful state of Colorado. Same with Oregon and Washington and California, which is the state where we were founded and where we have responded to the most number of wildfires. But we have spent a lot of time in Colorado, and we have spent time in Oregon and Washington as well. And we are doing our best to answer all your questions. Now, I know we got to a lot of questions tonight. And if you did not get your question answered, I encourage you to shoot us an email or come to one of those future sessions that I mentioned. Hopefully those of you who were listening in Spanish got through this and without technical.
Okay, I think she was going to say we got through this without
Thinking-
technical difficulties. Froze for a minute, right as I think you were saying technical difficulty.
Yeah. Well, I just want to say again, thank you, Chris, for sharing your expertise and your time. Sandy, the same. Thank you for sharing your expertise and your time, and the whole team up that's in the background here. Thank you, and our interpreters. So I hope everyone has a pleasant evening, and that all the talk about math and confusion wasn't too discouraging for you. We're rooting for you, and we wish you well on your journey. Thank you so much. Good evening.
Bye-bye.
Thanks, everybody.